despite life's risks of dying too soon, being disabled, and living too long. The amount of loss that a person or family could suffer in case any of these risks happen can be determined through the concept of human economic value, which speaks about a person's earning potential. This is what an individual has been able to accumulate in assets. What can be reasonably expected in the future as future earnings, and the economic value of an individual to his or her family. And to determine human economic value, take this example. A person is presently 30 years old. He earns 1 million annually. If the retirement age is at 65, this person's human economic value is computed this way. Count the number of years from current age to retirement age. Multiply annual income by the number of years before retirement. The result is this person's human economic value. One main factor to an individual's human economic value is sources of income, which we define as the recurrent flow of cash in exchange for service rendered or goods manufactured, characterized by money from work, for example, salary or profit from business, or money at work, for example, investments, and from donations and charity. Now we will identify the terms that make up our understanding of life insurance. Click on the tabs to know more. Premium, regarded as the consideration given by the insured in exchange for the promise of the insurer to pay a stipulated amount in the event of a claim or upon maturity of the life insurance contract. The insured, the person whose life is covered by the insurance. The policy, a written contract between the insured, specifically the payer or owner of the policy, and the insurance company. The policy owner, the person who pays for the policy. Here we continue with life insurance terms. Click on the tabs to know more. Face amount, the money which the insurance company will provide when the insured dies. Beneficiary, the person who will receive the face amount when the insured dies. Actuary, the person who makes the necessary assumptions and calculations with respect to the principal elements in a life insurance premium. The insurer, the company that issues an insurance policy to the insured. Let's look at the terms in this manner. An individual, the insured, wants to secure his and his family's future by preparing for life's risks. The insurer is the company providing the insurance product, in this case, us. The insured pays for the insurance policy. These payments are called premiums. These premiums are calculated or computed by the actuary. In case of life's risks, for example, the death of the insured, the sum insured or face amount will be given to the insured's beneficiaries. Before we continue with the rest of this section, let's play a game. Find the life insurance terms in this word search. At this point, let's look at risk and how life insurance plays a part in managing it. Risk is a probability or threat of damage, injury, or loss, known as the hazards on people's lives. This is why in life insurance, we protect people from losses that might arise from dying too soon, living too long, or being disabled. If we protect people against loss, how then can life insurance afford to do so? In the life insurance industry, there is the concept of risk sharing. It is shared by a group of people called cooperative risk sharing, where economic loss is spread over a large number of people. In essence, everybody is willing to accept a small loss in preparation for a greater loss. This is when people give up a small amount today to cover for possible losses in the future. kind of risk does life insurance accept? To understand this, we have to know the two types of risk, speculative and pure risk. Let's find out what each one means. Speculative risk, a type of risk that involves the possibility of gain or loss, like gambling or a business. Pure risk, a risk with no possibility of gain, like death, disability, or old age. Let's look at how life insurance works. Peter recently passed away in a car accident, leaving his 2 daughters in high school and a housewife or a widow. Luckily, he'd prepared beforehand and had taken a life insurance policy with a sum insured of $5 million. Thanks to this, his wife was able to pay all their mortgage debts, pay for the tuition fee of their children until college, and she was able to give her husband a proper burial. To find out more about how life insurance works, click on each tab for the definitions of terms. Cleanup fund. Immediate funds for funeral or burial expenses, medical expenses, estate tax payments, and loan payments. Income continuation. Funds for educational expenses, daily living, or capital to start a business. Welfare fund. Insurance contributes to the welfare of the country by accumulating capital for investment in commerce, partially relieving the community of the care of dependents, and encouraging provisions for the future. Before more sophisticated tools became available to the actuary, insurers would rely heavily on these tools to assess the present risks of a group of people they would want to cover. From these risks, they are able to determine which group of people to make their products available to, and the corresponding amount of premiums they are going to charge. The law of large numbers states that as the number of policyholders increases, the more confident the insurance company is that its prediction will prove true. Therefore, insurance companies attempt to acquire a large number of similar policyholders who all contribute to a fund which will pay the losses. This is used to estimate the losses a certain group of insured people may have in the future. This is referred to as loss frequency. For example, using statistics, an actuary looks at losses that have occurred in the past and predicts that in the future, approximately 2 out of 100 policyholders will have a claim. Thus, if the company writes 100 policies, it may expect to pay 2 claims. This is referred to as loss frequency. This is also used to determine the average cost of claims over time, referred to as loss severity. Imagine if the average claim resulted in the company paying $1,000, then the actuary will predict that the total losses for the upcoming year will be $2,000, corresponding to 2 claims at $1,000 each. Mortality table. A mortality table is also used as a tool of life insurance in calculating premiums. The mortality table shows the incidence of death by age among a given group of people. This chart shows how many pass away at a certain age. Life expectancy. Estimating the average lifespan of an individual can help in managing claims in the future. This pertains to the number of years that people will live on the average, as shown by the mortality table. Generally, females have longer life expectancy than males. Law of probability. The law of probability predicts the chance that a person will still be alive after a given number of years. For example, if someone were to get sick in the city, what are the chances that this person would be able to buy medicine or go to a hospital? You could say the chances are pretty high. Now, what if an individual gets sick somewhere in the mountains or in the forest? What are the chances that this person will be able to get medical attention right away and survive the ordeal? You could say pretty slim. Another example could be the probability of injury is higher for a construction worker than an office worker. Also, the probability of illness is higher for those who smoke and drink alcohol than those who lead a healthy lifestyle. We will now take a close look at what premiums are and how they work. But before that, what are premiums again? Click on the correct answer before you continue. age, type of plan, riders, amount of coverage, sex, and policy fee. Mortality, relative incidence of death among given people. Interest, earnings from invested premiums. Safety margin requirement, money set aside by the insurance company to meet adverse claims. Operating expenses or loading, overhead expenses of the company. Gross premium is equal to loading or operating costs plus the net premium, and the net premium is made up of interest and safety margin and mortality. What makes up a premium? Click on a tab to show the types of premiums. Single premium arrangement, a payment system that requires only one premium payment. The policy is considered paid for and is fully enforced. Click on a tab to show the types of premiums. Natural premium arrangement. Pay for premiums that increase with age by means of a gradually increasing premium, which reflects the increasing mortality rates as age increases. Click on a tab to show the types of premiums. Level premium arrangement. The policy owner can level up to a specified year by means of a life insurance pricing system that allows the purchaser to pay the same premium amount each year. Click on a tab to show the types of premiums. Graduated premium arrangement. Premium payments increase every year until the 5th year of the policy and remain at that level through the duration of the premium payment period. Click on a tab to show the types of premiums. Modified premium arrangement. Premium payments only increase on the 5th year of the policy and remain at that level through the duration of the premium payment period. Click on a tab to show the types of premiums. Fractional premium arrangement. If a customer wants to pay in installments, payments may be made monthly, quarterly, or semi-annually. A modal factor or conversion factor is used to compute for the premiums. Click on a tab to show the types of premiums. Single premium arrangement, a payment system that requires only one premium payment. The policy is considered paid for and is fully enforced. Click on a tab to show the types of premiums. There is a form of documentation that outlines when a policy takes effect. The premium receipt. It's given to the customer as soon as the payment has been made. The premium receipt has two types. The binding premium receipt, where the customer is covered immediately, and the conditional premium receipt, where certain conditions first need to be met. Click on the buttons to see their differences. Here's an illustration of how premium receipts work, from the submission of the application to the policy approval. In the event the client dies, where a maximum sum insured of $1 million is received. We also need to remember that the receipt, both binding and conditional, cancels once the policy is either approved or declined. When the insured dies and a binding receipt is issued, the sum insured is payable. When an insured dies and a conditional receipt is issued, the application will be processed as if the insured is alive. If the underwriting decision is that the policy is approved, the claim will be paid up to a maximum amount written in the conditional receipt. If the application is disapproved, paid premiums will be returned. A life insurance company pays for its claims and other future obligations pertaining to insured individuals through its reserves. All life insurance companies are heavily regulated by the Insurance Commission to ensure that there is a healthy level of reserves to pay for future claims. The IC requires legal reserves, policy reserves, and contingency reserves. You have just completed Module 1, The Foundations of Life Insurance.